Opportunity cost is a key concept that reflects the value of the option we choose to give up when we select another alternative. It refers to the value of the best available option that we forego when we choose a different alternative. In other words, it is a potential benefit lost by giving up the most advantageous option. In a context where resources are increasingly limited, understanding opportunity cost is essential for optimizing investment and financing decisions. Opportunity cost can manifest in different ways. For example, by investing in one company rather than another, we forego the potential return that the other could have generated. By choosing to invest in a particular asset class, we give up the potential return offered by other asset classes. Decision-making in strategy and finance may require comparing different options and assessing their respective opportunity costs. This assessment is based on a rigorous analysis of the advantages and disadvantages of each option, as well as a realistic estimate of potential risks and returns. Ignoring opportunity costs can lead to suboptimal decisions with negative long-term consequences. Let's take the example of an investor with a sum of money to invest. They can choose to put their funds in a low-yield savings account or in stocks with potentially higher returns. By choosing the savings account, the investor gives up the higher return they could have earned by investing in stocks. The opportunity cost of this decision is represented by the difference between the actual return from the savings account and the hypothetical return from the stocks. When a company decides to borrow funds to finance a project instead of using its own resources, its opportunity cost takes the form of the interest it will have to pay on the loan. These interest payments represent the cost of forgoing the use of its resources in other projects or investments. Understanding opportunity cost allows for a more precise evaluation of alternatives and helps in choosing the most advantageous options based on strategic and financial objectives. Whether in the field of investment, borrowing, or resource management, taking opportunity cost into account helps us maximize value and avoid costly mistakes. By thoughtfully incorporating and integrating this concept into our decision-making process, we are significantly more equipped and better prepared to successfully navigate and manage a complex strategic landscape and achieve our own